Let us help you reach your peak in retirement. It's time for Retirement Elevated with Sean Lee.
Hey, everybody. Welcome into another edition of Retirement Elevated. Thanks for tuning into the podcast with Sean and myself as we talk investing, finance, and retirement. We're about a week out from Thanksgiving. What's going on, my friend? How you doing?
Just preparing for the holidays. I'm doing well. Yeah.
Are you a Thanksgiving guy? I love Thanksgiving.
Yeah. It's the last couple of years have been a little weird, right? But
well, sure. But it's my favorite holiday, though, I think, for me personally.
See, I'm a 4th of July guy.
Okay.
Like that's my birthday's in July, but if you saw our offices, I've got American flags of all different types all over the place, super patriotic. And
nice.
That's the holiday. Like I order in advance a whole bunch of that yard paint, and we throw a big, 20-foot long American flag on our grass.
That's awesome.
And just paint it in, and yeah, man. But no, I enjoy it. I mean, this time of year it's cold outside, so we don't do much, but we are getting the family back together again.
Yeah.
And so it'll be good.
Well, I think that's kind of where it's kind of gone for me through the years. Now, I love the food. My mother was a fantastic cook growing up. My wife is now. So that's, like one of my favorite things is the eating, which everybody enjoys. But I think unlike Christmas, Christmas is cool when you've got little ones. And when you are a little one, when you've got little ones, or maybe when you have grandkids, but I don't have grandkids yet, so I don't know that quite that feeling yet. But I think Christmas sometimes gets too pressury, too stressful, So I think that's why Thanksgiving kind of slides in there as the winner for me, because you got family around and all that good kind of stuff, but it's not like the pressure of, did I get the right thing, or so on and so forth. So that's kind of my philosophy breakdown on Thanksgiving. But anyway, I hope that everybody enjoys theirs coming up. And this week on the podcast, or this go around, we're going to talk about financial half-truths. We hear a lot of these. I got some statements for you, Sean, that are pretty standard statements that people will hear or say in the financial world. And I don't think they're being said necessarily to be misleading. This just doesn't tell the whole story, right? So you kind of have to extrapolate out a little bit more of some of these nuggets, if you will, to kind of get people to realize that, okay, yes, that's true, but maybe not exactly for your scenario, like this, for example.
Right. Don't
worry about those losses because the market always comes back up in the long run. Well, it's true. If you go back and look at 100 years worth of data on a chart, of the market, it's basically always going up. When you zoom in, you start to see the ups and the downs and the ups and the downs. But by and large, it does typically always come back. It always goes up. So that's kind of truth. So what makes it a half-truth?
Well, I mean, looking at this, if you're 30 years old and you go through a market correction, fine. No big deal. And what
fine.
Actually, I'm a math guy. I love analytics, and there's this principle called the commutative principle of mathematics. And it sounds super nerdy, but I'll break it down for you. What that principle means is that I can take returns from 2000 to 2021, right? I could take those negative years and those up years, and I could run returns on a portfolio, and then I could take the returns in reverse, and I could go from 2021 up to 2000, right? So I just flip the returns on their head and I run them. And what that commutative principle of mathematics says is that it doesn't matter the sequence of returns that I get. I will have the exact same outcome if I go from 2021 or 21 backwards to 2000. Now, that's the truth of it. It doesn't matter about where you get the losses and where you get the gains, as long as they come. However, the issue that arises is when you're starting to withdraw money from those accounts. Now the sequence of returns does matter. Now, losses in your portfolio, if you're withdrawing from your portfolio, it does matter. Because if you get losses early on, it will have a long-standing effect on your portfolio if you're withdrawing out, because now you have to sell off more shares or do whatever to get that same level of income. And it's almost irreparable once you go through that if you don't have a withdrawal strategy put in place.
Well, think about it this way. We'll break it down a little bit further. So if somebody retired in 2010, they're probably in pretty good shape, right? So if they've got some investments in the last 10 years, they've been rocking and rolling But if you retired, the same guy's friend or gal's friend retired in 2007, not so much, right? Because they had 3 years. Yeah. They had 3 years of getting, hammered on, right? Of the economic downturn there. And so early on, that probably would have cost them a lot more in those early stages of retirement. So timing, and that's where the whole don't worry about it, it comes back in the long run is true, but what is your long run? Your long run may not be there anymore. Your time is not the same. The market's going to always do what it's going to do over the next 100 years. You don't have that long.
Exactly.
So long and a short of it, right? All right. So the fees in your portfolio are less than 1%. Well, 1%, whatever the number is, we typically hear that. Often that's true, but the half truth comes into place where they're thinking about what their guy or gal told them. Well, my guy or gal charges me 1%, Sean, so that's all I pay.
And I get this question like, well, what's your fees? I'm paying less than 1%. Okay. Well, let's talk about that. Like, let's get down to the brass tacks of it. And what is that fee for? Is that the advisory fee? Oh, yeah. Okay. Well, now let's break it down even further. What sort of investments do you have? Because the advisory fee is one thing, but just because you're paying an advisory fee doesn't mean that you're getting the funds or whatever that your advisor is using. Those aren't free.
I guess some target date funds. Well, guess what? You're paying more than 1%.
You're paying more than 1%. But now when we start to look at a layering of fees, if you look at mutual funds, just mutual funds, for example, if your advisor has you're using mutual funds, great. Then you've got mutual fund expense ratios. You've got cost of turnover. You've got all of those other, tax costs, tax drag, some of those other things that those are all costs that you're paying. The advisor's not paying those costs of the funds themselves, but you're disclosed, hey, here's the advisory fee at 1%, so you got to be really careful about what's out there from a fee perspective, that if you're paying an advisory fee, but you also have mutual funds in your portfolio, there's a good chance that you're paying way more than 1%.
You think about like your cell phone bill, right? So, Verizon or Sprint or AT&T, they offer and they say $99, right? It's $99 for your monthly. That's what your monthly thing is. Well, that's not true because you're going to have taxes, right? But then when you go to look at the taxes or the different fees, there's like the state tax, the federal tax. Sometimes there's a county tax. Then there's things like 911 surcharges and so on and so. There's all these little, tiny little things that start to add up. Same kind of thing within different investments and stuff. There can be a lot of little fees that are just not line itemed as well and easy to find. So that's another, again, kind of half truth. Right. When you're thinking about that. Let me jump to this next one. I'm going to skip down to 4 actually on the list. We'll come back around if we've got time. Diversification being the key. That's a big selling point. It's a big standard thing that the industry has been saying for years and years and years. So think about it like a set of keys on a key ring, right? So, or go old school, Sean, like an old house that has a skeleton key, right? That unlocks everything, like one of those master keys.
Right.
So is diversification that, or is it just a key on the key ring? Like it's an important key, but maybe it's not like the ultimate, like this. As long as you're diversified, you're groovy.
Yeah, diversification is a piece, right? So if you're starting to look at how you're building your plan and how you're creating your structure in your plan, diversification is just a component of that.
It's an important one, absolutely. But
I think people misunderstand what diversification actually is in a lot of instances. That diversification is not asset allocation. When we look at asset allocation is 3 different asset classes, right? So you got cash and savings, you've got income, and you've got equities.
Okay.
What diversification is, if I just look at equities alone, and that's stocks, stock mutual funds, ETFs, real estate, gold and silver. Diversification is diversifying through equities, or one asset class. So I'm going to diversify in the markets in large, medium, small companies, maybe some internationals, some gold and silver, whatever it may be. But I'm diversifying through that asset class alone. So that's diversification. Asset allocation now is incorporating all 3 asset classes and then diversifying through each asset class to build a plan that's customized to what the needs are. So if I need income, or if I need to create cash flow, or if I need, whatever it is, I'm going to be creating an asset allocation strategy that's diversified through those 3 asset classes. And when you do that, now you've got a full, complete plan. And I think that's where people really miss the boat. They're, I'm diversified through all of these different stocks. Well, that's not a plan.
No.
Right? So,
yeah, we've definitely talked about that before, where it's like they're all the same type of thing. So if the market has a huge downfall, If it goes like last March, it goes down 35%. Well, then every stock you have more than likely is going to go down. If it's across the board, it's going to go down as well. Versus being, well, I've got 7 mutual funds, so I'm diversified. No, same kind of thing, right? Versus, like you said, having some large cap, some small cap, some emerging markets, so on and so forth, some other types of things to ebb and flow. So it's important. It's an important key. It's just not like the master key.
No.
Or the skeleton key. Skeleton keys were cool. Remember those? They're like old houses and stuff. Those things are really neat.
You can get in anywhere.
Yeah, I know, they're great. And they're kind of creepy too, but they're really cool. All right, let's do one more here. Bonds significantly reduce the risk in a portfolio. Very tried and true-ism, but is it a financial half-truth, especially nowadays?
Sure. I mean, where are interest rates right now? 0?
Zippy?
Yeah, I mean, could bonds reduce the risk in your portfolio? Yeah.
In theory, right? I mean, and it's, again, by the large, they kind of do, but they're not without risk.
Until the government starts to raise rates. I mean, then bonds tend to have a recycle period where they take losses, whether it's a fund or whatever it may be.
Right.
Interest rates go up. You can't, if you have individual bonds, you have to sell those at a discount. So there is risk attached to them. But historically, yes, bonds have been that hedge against market corrections. When we look at the whole truth right now, it's all based on the current economic climate as well. With, hey, if we've got the Fed's deciding to raise rates next year and they incrementally do that, you're going to see some exposure to the bond market. It's just the nature of the beast. And so, yes, they do insulate you from the downside. They reduce your risk, but no, you're not. It's not like you're putting money in a savings account. There is still some exposure there potentially if rates start to increase.
Yeah, and if you've got a bond or it's something at a really low rate, or really it's not paying very well, 1%, let's say, and they raise it back up to 3 or whatever, and somebody comes along and buys the 3, well, and you want to offload your one, well, guess what's going to happen, right? Not that great. So
you got to sell it at a discount.
You got to sell it at a discount, right? Because who wants it? Because they can buy one, a new one at 3. So
exactly.
Yeah. So that has some risk. It's typically one of those things you think about a traditional 60-40 split or whatever. And as we get closer to retirement, that used to be the saying, well, shift to bonds. It's a little bit safer. But things have changed so much that's why it's important to get a good plan and a strategy put in place, because everything is a little bit wonkier than it used to be, and it can still get done. You just have to really work with someone who understands the ins and outs of this stuff. And so that's why we do the podcast, hopefully to share a couple of nuggets of information along the way. If you need some help, reach out to Sean and the team at Elevated Retirement Group. You can find them online at elevatemyretirement.com. That's elevatemyretirement.com. You might have gotten this through a newsletter or an email blast or something like that. If you haven't subscribed to the show, definitely consider doing so. Apple, Google, Spotify, whatever platform you like to use. Just hit the heart button on whatever platform it is, and you'll be subscribed, and you can catch new episodes when they come out, as well as check out past episodes. And, of course, as always, if you need some help, you got some questions, reach out to a professional before you take any action. 855-50-RETIRE. It's 855-50-RETIRE. Sean, thanks for hanging out with me, buddy. I hope you have a good holiday, and I will see you in December.
Thanks, man. Don't eat too much.
I'm gonna do it. I'm going for it. All right, we'll see you next time here on Retirement Elevated with Sean Lee, managing partner at Elevated Retirement Group.
Investment advisory services offered through Elevated Capital Advisors, LLC, and SEC Registered Investment Advisor.